All right, why don't we get started? So good afternoon, everybody. Welcome to the January Northwest Gas Association. My name is Connor Wrighton with the Northwest Gas Association. Today we're pleased to have two presenters on hand to discuss the future of rate making and the impacts that public policy can and will have on that process. We'll kick things off with Andy Satchwell, who will lay some of the groundwork, and then we'll move on to Steve Kihm. We had the opportunity to hear Steve present to a group of state legislators last year, and we're glad to have him back to give us some more details about where he sees the future of rate making going. And we're very pleased to have Andy to give us even more. So before we begin, let's go over the basics for how the webinars work. We have set aside some time for questions, and we strongly encourage you to ask them as they come up. Each of you will be muted throughout the presentation, so please use the text box to type your questions, and I'll interject as needed to introduce those questions. As you can see on the GoToMeeting control panel, there is a chat box at the very bottom where you can type those questions out. For those of you who would like a PDF copy of this presentation, please send me an email at creiten@nwga.org, and I'll get you a copy before the close of business today. Oftentimes, the easiest way to do that is just to respond to the email that I sent out this morning, and I'll make sure I get you that information. As you may know, the Northwest Gas Association hosts webinars like this one each month. We're currently finalizing next month's attendee, and we'll be in touch over the next week or so with details. And of course, we ask that you look ahead in your calendars and mark off June 6th and 7th for next year's 15th Annual Energy Conference, which is once again at Skamania Lodge. And finally, I'd like to introduce the Northwest Gas Association for those of you who might not be familiar with us and what we do. We represent the 6 investor-owned gas utilities operating in the Pacific Northwest, along with the 3 large natural gas transmission lines. Our members are located in Oregon, Washington, Idaho, and British Columbia. And as always, you can please visit our website at nwga.org for more information, or send me an email at creiten@nwga.org. And with that, I will pass things over to Andy here in a moment.
Great, thanks, Connor. So let me go ahead and get this slide up. Great. You can see that okay, Connor?
Yeah, looks perfect.
Okay, great. Well, thanks, Connor, for the opportunity to present to the Gas Association and guests today. I'm going to kick things off with sort of a framing, a couple of slides framing some of the trends that we're seeing in utility regulatory and business models, and then kick things off to Steve, who's going to speak about these and the incentives and disincentives in the regulated utility industry through a corporate finance lens. So before I begin, I did actually want to introduce Lawrence Berkeley National Lab, and at least the work we've been doing at the intersection of distributed resources and utility regulatory and business models, for those of you who may not be familiar. So Berkeley Lab provides technical assistance. A lot of the work that I'm going to be talking about has really borne out of work we've done directly with state public utility commissions, looking at the alignment of utility regulatory and business models with profit motivation and profit achievement, and how those may or may not align with state policy goals related to energy efficiency and distributed generation deployment. A lot of the work we do is quantitative modeling that looks at the financial impacts to both utility shareholders and ratepayers, both of this clean energy public policy goals, as well as changes to rate making, things like fixed customer charges, changes to net energy metering compensation, and the new sort of incentive mechanisms for utility shareholders. And so the work I'm going to talk about tries to broadly frame some of these issues, but draws on work we've done either in specific states, as you can see here, and regional workshops as well. So with that, there's a lot of different ways to frame the sort of future threats for utilities. I've tried to kind of simplify it here and really think about it from the lens of profitability and finance. And so there's several drivers that are putting downward pressure on utility revenues. And these include, especially on the electric side, distributed energy resources, as well as on the gas and electric side, and enabling policies for conservation and efficiency, as well as increased competition for services. At the same time, there's sort of upward pressure on costs for utilities. And a lot of this includes, drivers for large capital investments. This is either to replace infrastructure as well as to modernize infrastructure. On the electric side, we've seen a large movement towards what are sort of being billed as grid modernization proposals or major investments in the distribution network. There's also additional cost pressures to accommodate these higher penetrations of distributed energy resources, as well as costs generally for utilities to enhance cybersecurity and back office billing systems. And so what this is meaning is, in any environment with decreasing revenues and upward cost pressures, you have potential impacts to profitability. And utilities are either experiencing this or anticipating this, and so are suggesting different sort of future regulatory and business models that may alter the way that profits are achieved, as well as sort of the profit motivation component. So I'm presenting here a conceptual framework that we developed to try and describe generally these utility regulatory and business models. This draws on a report from a couple years ago that has a lot more detail, and I'm going to pull some material from that report in the next few slides here. But what we tried to do was, there's this sort of range of literature out there describing all these new future business models and regulatory models, and we tried to put them onto sort of a two-axis framework here to try and describe generally what these different models are trying to represent. And so you sort of have traditional cost of service regulation, which you can see here in this quadrant 3 in that sort of bottom left. And what that means is that utilities are really motivated to sort of build assets and increase rate base. This is part of the Avers-Johnson effect, where utilities have a bias towards capital rather than labor. There's also profit achievement through commodity sales, particularly on the electric side, commodity sales of electricity, which is how they recover a lot of their costs, both variable and fixed. And I would say the same is probably true on the gas side. What we're beginning to see is that you can describe some of these transitions as sort of profit motivation, less based on building assets and more about sort of value creation, either from existing assets or building new infrastructure to support sort of value and motivating that type of profit. At the same time, there's profit achievement that's moving towards services provision rather than sort of commodity sales. So services, whether they are customer-related services, data services, or even sort of traditional energy and grid services as well. And so I'm going to draw on some sort of more recent examples to try and describe some of these movements. So one is creating a value-driven utility. Discussions around performance-based regulation largely fall into this. And so performance-based regulation explicitly ties utility revenues to performance that are relative to some goals that the regulator has set. There's been pretty limited experience in the US with comprehensive performance-based rate-making approaches, but it's quite common in Canada as well as in the UK. And so maybe the sort of most well-known and potentially sort of whole, complete PBR model, probably best example is Great Britain's Rio Model. This replaced their prior PBR model that they had for a couple of decades over the past, and they've been implementing this really over the past sort of 3 or 4 years. The Rio Model is this acronym that stands for revenue equals incentives plus innovation plus outputs. And you can see here a graphical depiction from their materials about the types of scorecard metrics and the types of goals that utilities, both on the gas and electric side, are being asked to meet. You can see things related to customer satisfaction, reliability, safety, as well as sort of social obligations and environmental impact. The utilities developed the business plan with this sort of 8-year forecast of costs and revenues. Revenue is capped over that time. And then the regulator really takes on this role of both upfront setting outputs and baselines for performance, as well as ongoing inspections and deciding on incentives and penalties as the utility does or does not meet certain levels specified in the business plan. And so this is a very sort of value-driven approach. It's all about the outcomes rather than the inputs, and investments the utility is making. Similarly, we've seen, movements towards what I would call sort of a services-driven utility. This is a utility that will provide or enable some value-added service. On the electric side, you could think of rooftop solar, efficiency, or energy storage. But the point here is that services are priced to collect the revenues to cover costs instead of, commodity sales. And this profit achievement is really focused more on services that are either enabled or delivered by the utility, rather than that sheer sort of throughput or commodity sales piece of it. I think on the electric side, one of the more interesting examples is Green Mountain Power in Vermont. I pulled this set of pictures fairly recently from their website. And what they're actually starting to do is offer products to customers. And you can see that customers pay a sort of monthly lease cost. The detail here is for heat pump water heaters. You can see that they have monthly payments with pretty simple terms. And they also have what they've been calling an off-grid package, where customers can pay a sort of nominal monthly fee, and the utility comes in, provides efficiency upgrades, solar and battery systems in these remotely served locations or in places where the customer wants to be, quote unquote, off the grid. What's interesting here is that the utility is moving towards and sort of publicly facing themselves to be a services-oriented utility and less away from the commodity sales piece. Though I will say, if you look at some of these products, like a heat pump water heater, some of these, while more efficient technologies, may actually drive up utility sales as well. And so it might have sort of a double impact there from the utility's perspective. So with all that, I do also want to say that there's obviously a lot more than just this profit motivation and profit achievement set of axes for the framework. Really, regulatory paradigms and business models depend on a lot of different key dimensions, and this is what regulators and policymakers are currently wrestling with as these transitions occur. And so not only profit motivation and profit achievement, things related to market structures around vertical integration or retail competition, the role of the utility in providing these services. Is the utility actually going to take on an active role, or does the utility simply open up the network for third parties to provide these services to customers? The degree to which the networks are open and accessible to those third parties. Do third parties and customers have access to their data, or is it closed and inaccessible? And then there's also things related to risk, which Steve will likely touch on. Risk to utility shareholders. Are you shifting risk from customers to shareholders, or vice versa, from shareholders to customers, as well as these third-party service providers? So that's a really high-level sort of kind of flyby of some of these trends that we're observing in the industry. Steve's going to provide a little bit more flavor from a corporate finance perspective. I did want to leave my contact information here. We can discuss some things during the Q&A, and certainly feel free to reach out to me after today's presentation if you have questions. So Connor, with that, why don't we kick it over to Steve?
Sounds good.
Okay, can you hear me, Connor?
I can.
Okay. Oops, sorry, hit the wrong button there. So Andy and I do a lot of work together, and I'll probably be mentioning Andy and Pete, and because Pete Cappers is part of the triumvirate, the Andy, Pete, and Steve. We've done a lot of this work, so if I mention that, that's who I'm referring to. But quickly, Seventh Wave is, we're in Madison, Wisconsin. We have offices in Minneapolis and in Chicago. We are a research and policy firm, and we do some engineering work. We work for a variety of clients, utilities, state governments, federal governments, that do a lot of work with Andy and Pete, as I said, at LBNL. But I've been doing this is my 38th year of doing regulatory economics and finance, and one of the reasons I'm here, and LBNL actually has funded the time and energy that went into this webinar prep, so I appreciate that. But this is a study that I did for Lisa, Andy's colleague at Berkeley Lab, about incentives and disincentives for grid monetization. Of course, that is a specific topic that's more of an electric variety than gas, but the concepts are the same. So I'm going to actually pull those concepts out and put them into a gas utility context. The big question in grid modernization that was presented to us is, can electric utilities raise capital for grid expansion? So we can just say, can natural gas utilities raise capital? Turns out that that's actually not a very good question, because we could answer it with almost out any analytical work. You can just if you call any investment banker today, Credit Suisse, Goldman Sachs, JP Morgan, and you guys say, we need to raise $1 billion, they'll be glad to do it for you. This is almost never a problem as can utilities. The question is whether managers want to raise capital. That is really, now that is not always true. Because in some cases, while raising capital can create shareholder value, in other cases it will destroy it. So this is really the more relevant question, and this is really an important point because in regulation, sometimes this gets twisted around and we actually tend to equate the return on equity and the cost of equity. But the heart of valuation, if you do look at any valuation analysis, it's actually looking for a gap between those two. That's what we're going to do, and we're going to see that actually today there is a gap between them for utilities, which is actually a good thing. You want to have a return that's higher than the cost of equity because that's the only way, as this last point says, you can create value for your shareholders. And you would want in a dynamic public policy setting, it would not be good policy to actually force utilities into a situation in which they can't create any value. And we're not the only ones, and I'm not the only one that says this. If you read Economics of Regulation by Alfred Kahn, or The Regulation of Public Utilities by Charles Phillips, this point is actually hammered home, but we've kind of lost it, and we tend to think of these two things as the same, and if you do think of them as the same, you will not be able to follow the flow at all of a valuation analysis. And valuation analysis actually has a test. We can see if our model hits the stock price, and if it does, then our model is on track, and if it doesn't, we're doing something wrong using standard corporate finance valuation. So let's talk about these two things and how they're different. Let's start down on the bottom with the thing that we can actually observe, which is the return on equity. And I've got a who, what, and where here. So who earns the return on equity? The company earns it. This is a really important point. Investors never earn the return on equity. This is a fundamental point. The company earns it on its books, which is an accounting number. Cost of equity. Who earns it? It's an investor, not the company. The company never earns cost of equity. So if somebody says we're trying to increase our cost of equity, that's a bad thing. And companies would want to increase the return on equity. They would never want to increase their cost of equity. It's what investors expect to earn on the stock in the financial markets. Two fundamentally different numbers. Let's talk about, though, what shareholder value isn't. So I've said that it's going to flow from the difference between the return on equity and the cost of equity. This is from Credit Suisse. If you're really interested in following up on this valuation discussion, this is a great, you can just Google it and you'll find it. Credit Suisse, capital allocation. Michael Mauboussin, head of international investment strategy, does a lot of work with executives, and it gets very frustrated because many CEOs say their goal is to grow their company. Well, that is really not very close to shareholder value, and I'm going to show you that in some cases growth can destroy value. In real world situations, it's a very fuzzy idea that this is somehow good for the company. It might be, it might not be. This next one is going to surprise people, but I guarantee you, if you took a corporate finance class anytime after 1950, you would have learned this in the first week, because this is actually the essence of corporate finance and why we switched to valuation and value instead of profit. Profit is an input to our valuation. It is not the goal. And we'll see this. But here's a case where trying to increase profits by growing destroys a lot of market value. And this is a utility example. It happens to be electric utilities, but it makes the point nicely. From 1965 to 1980, if you look at that dashed line, that's the index stock price. You can see that the industry, as represented by this index, went from about $120 a share to $60 a share, which is lost half of the value of in the whole industry. But it's actually worse, because if you take inflation out of that, 75% of the market value in the utility industry was destroyed over this period. And one of the contributing factors is profitable investment. The fact that utilities were making investment is what was driving this down, because if you look at the R and K on that chart, they were making higher profits than they are today. So if you looked at their accounting statements from 65 to 80, they would show much higher earnings, much higher book value. Everything on the accounting statement was going up. But we can see that the stock price went down. Why? The opportunity cost of equity was 14 to 20%, and just as finance predicted, the valuation frame predicts, value was destroyed on a massive scale. So it's not R, it's R minus K, and they're not the same, and here we see a gap, and there's value destruction. This is actually a good book that by Thorndike called The Outsiders, and he looked at the most successful CEOs in terms of delivering shareholder value. And what he found is that many of them shrunk their companies. They did not try to grow. They did not try to maximize profits. They tried to maximize shareholder value. So that's a really interesting read. It's a straightforward read. And one of the people that he lauds is Buffett. Now, this is a very impressive track record. Warren Buffett, so the brown line on the bottom is if you invested in the S&P 500 in the year that Buffett formed Berkshire Hathaway, your $100 would have grown to about $3,000. That's a 30 times. But if you had invested with Buffett, your $100 would be over $1 million, which is a 10,000 time. Okay, so what does Buffett attribute this to? Everything I'm telling you, capital allocation. That he knows that you've got to make a return higher than your cost of capital. If he can't do it, he doesn't put money there. Like when he goes for a merger and acquisition, he puts in a bid, he doesn't ever raise his bid. If there's a competitor comes in, he just walks away from the table. So there's a lot of real data in here. I'm going to show you some more in a minute, gas utility data. But here's sort of the conceptual model, and this comes from McKinsey and Company. This is a good book. This is a deeper dive, this valuation book by Kohler, Gerhardt, and Wessels. But if you're really interested in valuation, that's a good book. But it's a fairly simple frame. The V would be the annual contribution to shareholder value. And how do we measure it? Well, we look at what the company earns, what investors expect in terms of the market, which is the cost of equity. If that's positive, which it actually is today for utilities, then we want to grow by running capital through that I. If R is equal to K, and this is a lot of people in the utility industry say that's commission set R equal to K, so that's got to be 0. Well, then there's nothing you can do to create additional shareholder value. Whether you invest $1 trillion or nothing, that V is the same. If you divest capital, the V is the same. You would be put in this position where you can't do anything to create value, and you wouldn't care if you ever built another asset. Your stock price would be unaffected by that. But if you think your stock price benefits from capital, R must be greater than K, and it actually is. In that 1965 world where R was less than K, then you could see what would have been the optimal policy if the utility had the ability to do it would be actually to divest capital, to shrink. That would have actually pushed their stock price up. So this simple little equation tells us a lot. Here's an actual valuation model. This is called the residual earnings model. You can see it right there in the model. This is, you take the book value, and then you look at the difference between R and K, and that's the value proposition. If R and K is 0, all those terms will be 0. And your price will trade at book value. So if your stock price trades above book value, know that R is greater than K. And again, no problem with that. That's the way things should be. Driving the stock price to book value puts the utility sort of in that dead zone in terms of creating value. But now this is where some people have trouble understanding this, because it seems so far from the way we look at things in utility, in regulation and rate making. But this is how valuation occurs. So if you want to determine the value of your company's stock, and will an action cause the stock price to go up or down? And even if you're a subsidiary, this will feed up to the parent. But this is a really important chart. If you look from 2000 on, Credit Suisse has used a cost of equity for the S&P 500 of 8%. That means the cost of equity for a utility would be probably 7%. No one is saying that the regulator should set the return on equity at 7 to 8%. Look up in the upper corner there. The R over this period was about 15. The whole essence of valuation is those two have to be pulled apart. And to do it, you have to estimate the cost of equity like a valuation expert does. And how do they do that? That's perhaps different from a rate making case. Well, first of all, let's go to another investment source. This is Morningstar. they follow 3 gas utilities, investor-owned gas utilities. Are those numbers less than 8? Yes. Okay, so they're consistent with Credit Suisse. Utilities somewhat less risky, should be lower. And notice that they're all the same. That's actually good finance because only systematic risks that are like interest rates, recession, and inflation affect the cost of equity. Firm-specific risks do not affect this number. So utilities should all have about the same cost of equity. And let me show you an even more dramatic case of that. Let's switch over to the electric utility industry for just a minute. And if those of you who have been following the Southern Company and their Plant Vogtle problem, you can see the top line here is, this last 5 years, is the Spire ETF for utilities. And we see that it's up 33% in terms of capital appreciation in the last 5 years. And Southern Company is only up 6. The fall off in both of them in the recent times is as interest rates have picked up a little bit, but basically Southern Company's not keeping up. So a lot of people say, oh, their cost of equity has risen. No, their cost of equity, we're going to see, has not risen. But here's the problems they're having, big problems. $25 billion, that's about a $12 billion overrun, and it's 3 to 5 years behind schedule, bankrupt builder. What's their cost of equity? 7.5%. That's Morningstar's number. Why? Back to the valuation principles. Most risk a company faces have no impact on its cost of capital. This is a strange concept for many people, but it's the core of valuation. This is how markets actually work. This is both theory and practice. We can see that manifesting. So the only things that matter to you and the Southern Company in terms of your cost of equity. It's not that those other things don't matter in some sense, and I'll show you how they matter. But in terms of the cost of equity, it's sensitivity to macro events, interest rates, inflation, or recession. So listen carefully now to what I'm saying. All firms, in this respect, face exactly the same risks. There's only like 3 or 4 risks that all firms face that drive the cost of equity. That doesn't mean that all firms have the same cost of equity, because if you look carefully, it's sensitivity to those risk factors. And utilities are much less sensitive to, say, a recession, because people still keep their lights on, than would be a manufacturing firm, which may have to shut down production. So the risk factors are the same, the sensitivities are different, but this is all you have to worry about if you're doing cost of equity. You don't have to know anything about what's going on at the commission, or problems like the Southern Company's Plant Vogtle. That will not affect the cost of equity. It will affect, here's where that big, why did the Southern Company struggle then? It's investors are worried that if there's a disallowance, Southern Company really won't be able to earn the R on all capital investments. So even if the commission gives it 10%, it gets to recover 80%. That's not really a 10% return. That's actually a much lower return, because you have to put all the capital in the base. So the risk, it's interesting, this is that R is where most risks manifest, and K is only macro effects. So if you don't do your analysis this way, when you estimate stock prices, they're not going to match. So you're going to say something's wrong with my model. It's not that the model is wrong, the inputs are, you're putting things in the wrong place. So how can we get cost of equity estimates if we don't want to just take Credit Suisse or Morningstar, if we want to estimate our own? Many of you know the CAPM or the dividend discount model. I want to talk about this dividend discount model just briefly, because this is a big place where we see really problematic analyses, often in rate cases. I'm going to say this one more time. We never would use these models to set R. We're trying to determine K, which was a completely different variable. So my critique here is not that regulators should lower R, but they shouldn't use these models to set R. We use these models to determine K, a fundamentally different variable. So when we look at K and long-run growth, what do we often use? Well, analyst growth rates are almost sacrosanct in rate proceedings. I would say every utility, every commission in the country says, yeah, these are good estimates of long-run growth. Turns out they're actually terrible estimates of long-run growth. Well, first of all, they're not really long-run growth, because at most they're 3 to 5 years. But secondly, they're overly optimistic, and they tend to be inaccurate. So this faith that we put on these analyst growth rates, and they can be quite high can actually tend to bias our cost of equity upward. If we look at the S&P 500 for a moment, back to that, you can see that GDP growth is sort of a limiting factor. So if you're using a multi-stage model, at the end, this has got to be you shouldn't go beyond GDP. No firm can grow faster than GDP. But if you're using a constant growth model, then this also has to be your limit because it's the long run estimate. If you don't like this as a long run estimate, don't use the constant growth model. But never put stock analyst forecast into a long run model. That will give you crazy numbers. It'll give you like cost of equity for the S&P 500 like of 12 to 13%. We know that can't be right. It's just way too high. It assumes the companies will grow many times faster than the economy. So the last slide was historic growth. So forecasts going forward are for GDP growth of about 4 to 5%. So that means S&P 500 is not going to grow more than 4 to 5% in the long run. Once we start limiting S&P, utilities grow. This is another error we see. Oh, the utilities will grow at the GDP rate. No, they'll actually grow over the last like 70 years. Utilities have grown at about half the GDP rate. So, because they're the slowest growing sector in the economy. What I'm trying to do here again is not lower your R. Remember this. I've separated this out. I'm looking at trying to get a good estimate of K because I need this to do valuation. If I don't have a good estimate of K that's cleaned up with all of these problems taken out of it, the models won't work. But now here's some real data using the value line numbers. Value line companies, there's 8 investors, there's 3 followed by Morningstar, and Value Line follows 8. They also follow some others that are like international firms. So here's the 8 domestic. On the x-axis, we see the return on equity that Value Line projects for these 8 companies. And it's a wide range, 9.5 to 13. On the y-axis, so that's R on the x-axis, on the y-axis is K. What will investors expect to earn? Remember, as Credit Suisse is telling us that it's about 8 for the S&P 500, so these numbers should be less than 8, and we see that they are. Turns out on average they're about 7. Says one more time, we don't want the R set at 7. We want to observe the K, which is about 7. So what's happening here? This 13% for Chesapeake Utilities. Some people think, oh, Chesapeake Utilities has an advantage in attracting capital because that's a higher return. But remember, investors never earn the return on equity. They earn the cost of equity. So what's happening here to convert this 13 to 7? Well, Chesapeake earns 13 on its book value of $27.36. So if you could buy Chesapeake at, I would say get off the webinar right now and go buy it because you're going to get 13% long run return. But guess what's going to happen when you try to go to the market to buy Chesapeake? You're going to have to pay $73.75. You don't get 13% on $73.75. You get 13% on $27.36. That is such an attractive return that everybody wants that stock, and it's bid up to 2.7 times. So if you go to buy it today, after this dilution, you'll expect to make 7.1%, which is the cost of equity. 13% return on equity, 2.7 times market to book, 7.1% effective return to the investors. You've diluted that down to a market rate. How about Spire, the old Laclede gas? It earns a lower return. It's at the other end, 9.5. But if you could get 9.5, that's actually a good return, but you can't get 9.5 either. The book value is 41.6. That's what you earn the 9.5 on. But you have to pay $69.30, 1.7 times, not 2.7, but 1.7. Effectively, what do you end up with? 7.2. It turns out that the market is not going to just leave hanging arbitrage opportunities that allow you to just pick off the high return on equity companies and invest in those and not invest in the low ROE companies, because everybody would do that, and you could see that that would be self-correcting. So you pay 2.7 times book for Chesapeake, you make about 7 for your new investor, you make 9.5 if you're Spire, new investor, Spire makes 9.5, new investors make about 7. So this is really consistent with finance principles that said all firms of the same risk should produce the same expected return. So this lines up really nicely with corporate finance. But here's where, this is the point that very few people understand, and it's critically important, and this is why R and K are fundamentally different. So the new investors, think of that as like about 7.1, 7.2 for those two utilities, or for all those two utilities we looked at. The amount of capital that's going to get put in, say $1 million, the new investors are going to earn every year K times that new capital of $1 million. This is the annual contribution, so every year they'll get that. But the utility makes R. Somebody who's got that money's got to go that extra return has to go someplace. The new investors have diluted it away. Where does it go? It's a windfall to the existing investors. This is really important because utility managers do not work for the new investors coming. People that have not yet bought your stock, if you think about it this way, do you want new people buying into your company to pay a low price for your stock or pay a lot for your stock? You want them to pay a lot to come in. They're at arm's length. Managers protect the existing investors. And this is a wealth generation, because what's going to happen is this difference in R and K is going to, times the $1 million, is going to inure to the benefit of the existing investors as a windfall. And it's a windfall because they put no money in. And why do I say this? Because this is fundamental corporate finance applied to utilities. Stuart Meyer's application of finance theory to public utility rate cases. This is the value proposition right here. This is what we want. Notice his more formal language of what I just said. An opportunity to invest in a project offering more than the cost of capital, R greater than K, generates an immediate capital gain for investors. It's windfall because it's realized ex ante. What does that all mean? Well, let's say the commission tells, your commission says, if you make investments, and let's say Spire at 9.5, if you make new investments, we'll give you 10.5, okay? And Spire says, yeah, we think we'll make some investments. Immediately, the Spire stock price goes up. You don't have to wait for the, investors are smart. They are going to impound that value from future projects. If you think about what a valuation is, it's the future cash flows discounted back, and there's going to be additional cash flow. So as Myers is saying, this creates, so the commission just didn't make it any easier to attract new capital. They made the managers of the utility much more interested in making investment because they can make their existing shareholders wealthier. That's actually how incentives should work. They're not supposed to make the new people wealthier. They're supposed to make the people who the managers work for wealthier, and that's what finance, that's how corporate finance works. So if we look at the details, we see that Chesapeake's R was 13, its K was 7.1. So that means for every dollar, for each year, for every dollar of capital that was committed by the new shareholders, the existing shareholders get extra 6 cents as a windfall. For every dollar, they get 6 cents, so multiply by $1 million. How about Spire? The existing investors who aren't putting any more money in get 2.3% free. Remember, these are windfalls. You don't have to, these numbers don't have to be very big for you to actually generate, you're taking other people's money and you're getting a windfall in terms of a higher stock price. So you'll take whatever, it doesn't cost you anything. So you'll take whatever you can get. So what would conclude? Now, some people make the mistake here of saying, oh, Chesapeake Utilities can attract more capital. And if you followed everything I said so far, you would say, no, that's not right. They can't attract more capital. They'll make this, the new investors make the same. What Chesapeake can do is create more value. It has a greater incentive to help make its existing investors wealthy. It can really earn 13% on the increment. But Spire also has an incentive to invest. It's just not as strong, but the qualitative signal is the same. There will be no difference in their ability to access capital, and they both qualitatively will want to invest capital. It's just that Chesapeake will make more for its existing investors. So here's the 2-point summary. Chesapeake has no advantage in attracting capital over Spire. Why? Because the new investors make the same, about 7%. But Chesapeake can create more value for its existing investors, so it'll want to go, but Spire wants to invest too. So interestingly, you'll notice that even though it's different, Chesapeake will really want to invest, and Spire also wants to invest. Now, we're going to show what happens though, as R gets closer to K, that value proposition starts shrinking. And some utilities, since R's vary widely across utilities and K's don't very much, you're going to get the situations in which some of these R minus K gaps are negative and some are positive, and that's where you have a fundamental difference. And we'll do that example right now. Let's say there's a huge spike up in interest rates and returns stay about the same. This is actually what happened in 1965 to 1980. Interestingly, returns stayed about the same, earned returns, and K's went through the ceiling. So how would that change things? Well, Chesapeake still has the same qualitative signal. 13 minus 11, that's positive. If it invested, it creates value for its shareholders, the existing shareholders. But now look at Spire. Spire will destroy value every dollar they invest. So the stock price will have been driven below book value. So the utility has to sell its stock at a discount. That comes out of the hide of the So the existing investors are now watching their stock go down as Spire has to continually offer their stock at lower prices to get new investors. So again, Spire can raise capital here with ease, because utilities in the 70s raised billions of dollars of capital when their R's were less than K. Why? Because the new investor never gets hurt. They just price the security and they'll get 11. The new investors they'll price the security to make sure they get 11. So you don't have to worry about them, and managers don't work for them anyway. They're on the other side of a table when you issue securities. They have their own counsel. If you think about a securities issuance, customers that you're going to sell them to aren't on your side of the table. They're on the other side of the table. They're trying to get a low price. You're trying to get a high price. But under this 11% scenario, again, no advantage for one company over the other in terms of attracting capital, because it'll just get priced out and they'll make the same. But this is the big difference now. Chesapeake can continue to create value, but now Spire will destroy value. So now we got different signals. And if the regulator of Spire didn't like that, then you'd have to raise the R. You would have to get the R at least up to K to make them neutral, and above K to actually create an incentive. So we can see that historically, that is what back in the 70s, this was really, everybody was in Spire's position. And utilities said at one point, the CEOs testified before Congress that they were going to start building oil plants instead of coal and nuclear plants, because oil was a pass-through and it was a low capital investment, and coal and nuclear capital was killing them. It was just, so we see this model plays out in terms of stock prices. It plays out in terms of utility executive behavior. So it's a very nice frame, but you can see that this may be causing some, there would be, if I were in the audience, there might be some puzzled looks, because I'm approaching R and K like a valuation expert. I'm not trying to set the two equal to each other. I don't use cost of equity models to set R at all. That would be defeating, because then you would never have an incentive. And I want to create an incentive, just like Alfred Kahn says you should, and other people in like Kenneth Train in Optimal Regulation said, if you set R equal to K, utilities might as well shut down the business, because it can never create value. So if you think R should equal K, you're actually, and we've sort of accepted that in regulation, it's actually contrary to institutional economic practice. Because if you read like Kahn's book on regulation and others, you'll see that idea doesn't hold. So I hope you saw with that last example, especially with Chesapeake and Spire, that we shouldn't say utilities have an incentive to do this or that. We should say, you tell me the R and tell me the K, and then I'll tell you what the incentives are. It's because you can have differential incentives like we saw with R and K, with Chesapeake and Spire. So that's a very fast review of valuation, but Andy and Pete and I have written some reports. We wrote a report for DOE, which we could make sure you have, Connor, which shows what happens if utility growth, capital growth stops. If R equaled K, if those two were actually equal, utilities shouldn't care again if they ever built another asset. But we show, but utilities do care. And why do they care? Because value will be destroyed, because R does not equal K. And Andy, I don't know if you remember the range of like losses. Some utilities that had R's close to K lost, like when all the capital growth went away, were like 5%, and some who had big gaps lost like 50% of current value, something like that, Andy?
Yeah, that's right. 54%.
Yeah, so that report is kind of interesting because it shows the valuation. It also makes a point that should be intuitive. If the regulator said you're not going to build anything else, as a utility, you shouldn't like that. That report says, yeah, you shouldn't like it. But if you really believe that R and K are the same, truly, you should not care, because your stock price will be unaffected. So that's maybe a nice sort of piece of icing on that. And so I'll turn it back to you with that, Connor. Connor, do you have it?
Connor, we're not hearing any audio.
Yeah, and I'm not, Andy. I'm back on. I see the title slide. Is that
Hello, can you hear me there?
Yeah, we're here.
There you go. Sorry about that. Just once again, if anybody has any questions, I encourage you to use the chat box there in the GoToMeeting control panel. We'll give you a couple of minutes to do that. Again, just want to thank both Andy and Steve for taking the time to do this. Really appreciate it, and a very good presentation. Also want to remind folks that we do record these, and we'll put these up on our NWGA YouTube page. That will be up there here in about an hour. Again, if you send me an email, I'd be happy to send you both the link to the YouTube page, as well as the slide decks that were used here today. So again, thank you to you both, and we will give folks about 30 seconds here to enter their questions into the chat box. And
just some housekeeping. Andy, can you send Connor that DOE report that we did on growth?
Yeah, I'll send Connor some links. That way, Connor, if you want to, either post those or send those out with the presentations, please do.
Perfect. Yeah, I'd be happy to send those out to folks who are interested in those as well. Again, everybody should have my contact info, and please feel free to reach out. All right, so we do have one question here, and that's, can you recommend resources for those of us not up to speed on utility finance issues, sort of a finance 101 kind of deal?
Yeah, I get that. I think Andy and I both get that. So I would say actually that paper that I recommend, the one that we did on how growth affects utilities, and Andy, you can agree or disagree with me. It lays out a fairly simple model which is built on these ideas, and I think that would be one. So yeah, like the McKinsey book that I mentioned, that is probably too deep of a dive, because they go into something called free cash flow models and stuff. It's built on the same concepts, but I'm not gonna recommend that. A book that might be worth it, that's pretty good, is by Penman, P-E-N-M-A-N, Stephen. It's called Accounting for Value. And so he takes, and this will match up the idea of rate making, which is really where accounting meets finance. He presents what's the residual earnings model. I showed that earlier, that actually has the R or K essentially in it. So that would be my recommendation. Even though it appears to be an accounting book, it's actually a hybrid of accounting and finance, which is actually really nice, because that's what you need, some accounting inputs to run the valuation. So that is Columbia Business School Press, and I'm looking for a date here. It's 2011. So Stephen Penman, Accounting for Value, Columbia Business School Press, 2011 would be my recommendation, rather than McKinsey's valuation book that I use in the slide. Another place that you can go to learn this is Damodaran at NYU. That's D-A-M-O-D-A-R-N. he had just Googled Damodaran corporate finance, and he'll take you to a treasure trove of information on valuation and corporate finance. And he has like lectures in there, and there's a lot of good stuff. So I would say Penman and Damodaran are good places to start.
Excellent. Thank you, Steve. And I think we are probably good to go in terms of questions. So again, really appreciate the time from both of you. Anybody who wants more information on getting these presentations, please reach out. And otherwise, we will look forward to seeing everybody next month. Again, we will be in touch here in the next week or so in order to let you know who that's going to be and to give you an opportunity to sign up for that. And we will look forward to it.
Thanks, Connor.